Good morning, everybody. Welcome to this Flow Show, Thursday, the 18th of April. I hope you are doing fine and dandy this morning. Kay, are you doing fine and dandy this morning?
Fine and dandy this morning, Ryan. Good morning, and good morning, everybody. Ready to rock and roll.
Yeah, once again. Well, short day for me as I'm heading up to the big smoke. Yeah, I'll leave you all to it later on. Right, let's have a look at what's been going on in the world. PBOC Governor Zhu says there's still room for monetary policy going forward. He says policy measures that have been unveiled are showing effects. So that's sounds like they're going to stay on pause, but ready to hit the button should they need to. Over in Japan, Rengo out with their fourth survey on wages, saying that firms have offered average wage hikes of 5.2%. Just after you were asking if there'd been an update on those yesterday, mate.
Yeah. But the thing is, we know about those unions, but I'm looking for it, but I still haven't found the global average.
Yeah, the national one they bring out, but I think that one's down a bit. Was it 5.21 or something in the third survey? So it's
still
around
well above inflation and still the biggest wage increase on record, I guess.
Yeah. So still looking good for that. Let's see if it can be maintained. It's going to be a bit heavy for them if wage increases next year are low on existence because they can't push them. But anyway, that's for then. So we've got all the Japanese mob over in Washington for this IMF G20 shindig stuff going on. Japan's Kanda was asked about the chance of joint FX intervention, and he declined to comment on any specific measures. Now, the US, Japan, and South Korea have agreed to consult closely on FX and market development. South Korea, also a country worried about what's going on in its currency as well, to do with intervention and whatnot. It sounds like a headline, but they consult closely on FX and market developments all the time anyway. So it's just reaffirming sort of what we already want to know and just putting it out there in the public. No real comments from Suzuki while he's over there, apart from the usual waffle. So no real change there. Kay, are they setting up anything over there, or
they've always ruled it out once they're back from the Washington bash, once they will be back in Japan, as I said. So there's two things that I'm looking at is that they did get their silent green light, both of them, because Yellen said they acknowledged the issues, and the G7 directives are also leaving that possibility open when markets are going against the fundamentals or are out of line or going too fast or too erratic, that they can intervene. So Japan and Korea, but let's say Korea is of a smaller nature but they regularly intervened already. But yeah, Japan is going to be the big market impact if they ever do. So the green light they have, and then what I've also been saying, but there is this thing that I don't think they will intervene for as long as they're out of the country, because they want to have really a close eye on what's happening, right? It's like, I don't think Suzuki wants to be out of the country when he's directing the interventions. Kanda can take care of it, or somebody else in theory, but I guess they will want to be present, right?
Yeah, and they've agreed that these G7, G20 things, they always issue communiques on what they've agreed and so on and so forth. And I think the lines on FX have been pretty similar. If I'm not mistaken, it's Japan that writes the lines for that FX part all the time anyway at these meetings. This is something that's gone on for several years now. But Japan write up the communique and everyone agrees it. So yeah, the green light stays green. I don't think there's been a time when it's actually turned red. But
No, not
anyhow,
really. But I mean, it's also a message to the markets, right? Right,
yeah,
and saying that like, hey guys, look, we have the agreement. We can intervene whenever we want. Now,
yeah,
it could, yeah, as we've been saying already on the shows, as I've been saying, it could be on BOJ this time. You know, when the if the Bank of Japan, due to the level of the yen, would do something, and then the market reacts adversely once more, I think then it could be bingo.
yeah. It could almost be like a bit of a Draghi situation when way back, I think he said every 10% move in the currency adds
Yeah,
zero point
then yen. Yeah.
0.4 basis points onto inflation or whatever. So yeah, it could be a similar situation where UADA starts making those sort of remarks if the currency keeps weakening, but we shall see. Anyway, it will still be in communication with the MOF any which way. They'll know what's coming. And speaking of the BOJ, Noguchi said that last year's spring labour negotiations have triggered an unprecedented wave of wage increases. They say they will gradually hike rates and adjust bond buying. But in March, he thought it was appropriate to keep the negative rate. Obviously, he was outvoted on that. It says under new policy framework, the pace of adjustment in the short-term policy rate will be made at a pace that is incomparable to that of other major central banks, i.e., they will go slowly. It will take a significant amount of time until trend inflation continues to rise around 2%. Says the economy is in a moderate recovery trend, but growth has been stalling recently. And he's not saying that the BOJ won't hike again this year. He's fairly dovish, this guy, isn't he, Kay?
Yeah, yeah. Noguchi's never been really a hawk. Well, let's say there's not many hawks at the at the Bank of Japan.
Yeah, that's true.
Perhaps only one real one, but uh, yeah, they're all just like staying the line, you know, and just repeating what they've been told that they have to repeat, in my opinion. By the way, while we're on Japan, next night for us is we have the Japanese CPI coming out as well. So I think any data point right now, if the market really reacts adversely, is still going to be a risk. So I'm usually rather tempted to say that, well, I mean, 99.99% of the time they don't intervene, right? But I'm usually saying that it's the market expects too much. But today and this week and a half going forward, I think we are in heightened intervention risk. I I'd be very worried for the yen if if we stay at these levels or even trade 155, 156, Bank of Japan stays doesn't do anything. CPI comes down just a little bit, and we're going into that scenario next week. Then I'd be really worried for the yen because then we could trade 160 very, very quickly. But I've got the impression they won't let it go up to there right now. That's the impression I get.
Yeah, yeah, very much so, mate. There's the CPI data that's due early hours of tomorrow morning. Expected to largely follow the Tokyo numbers. They dipped a little bit by a pip or so a couple of weeks ago. So this is looking to do the same, just drop a pip in the core and national and the other cores that they've got going on as well. So really here, if we're less than 2.7%, you know, maybe something like 2.5%, then we're probably going to see yen weaken quite a lot. And depending on where we are, might even take out that 155. But conversely, if we do get a number that's maybe unchanged or even hotter in those, then we could see yen gaining some as well, as the market then starts getting all its expectations changed around for future hikes. Right, moving on. Aussie jobs data out overnight, and a bit of a reversal of that strong number we saw. Where am I going? Where am I going? Where am I going? There we go. So down 6.6k was expected to come in up another 7.2. So it's a bit of a reversal, not anything that takes too much away from that number, which actually got revised up. It came in at 116.5 last month. So it got revised up by just around 1,000 people as well. The participation rate came down a bit, and unemployment rate went up a bit. So that's a tiny bit of a negative, more negative there, but to be expected with a negative employment change anyway. So yeah, a bit of a pullback, but not really damaging, as I say, that big number that we got last time there. So nothing really for the Aussie dollar to get its teeth really stuck into, or the RBA. BOE's Bailey says the UK economy is on track with the bank's February forecasts. It says to expect a strong drop in inflation next month. That's in kicking open an open door, because we've had another cut in the energy price cap, which started in April. So no surprise that inflation should drop on the back of that. He says he's seeing services inflation coming down gradually. And he's taken a line that a lot of central bankers are at the moment, getting their excuses ready, saying that the risks remain from the Middle East conflict. Over in Germany, Finance Minister Lindner says that it's disappointing that Germany's economy is not growing and structural reforms are needed to get out of the misery. Well, very miserable over there by the sound of things. ECB's Hawke Holtzman says the biggest threat is geopolitics. Another one citing that line, saying rising oil prices would be a major shock. The ECB moving ahead of the Fed means cuts are less effective, which is a bit of a strange comment if you're just doing policy for yourself, not in terms of how others react or don't react to it. Probably a little bit of a nod towards the what happens in the currency when one bank goes over another, and that features by one of the other commenters as well, which I'll touch on. Also says significant progress on inflation. It's about time to change monetary policy. Oh no, that's not his comments. That's Centino's comments. Sorry, Centino saying there's been significant progress on inflation. The ECB won't decide on all cuts at one meeting. Several cuts are possible in the course of the year. It says it's about time to change monetary policy. Says there are signs of decoupling between the Eurozone and the US, but monetary policy in the Eurozone will not be guided by the Fed. ECB's Cipollone says we see some signs of economic recovery. Now, interesting, I learned yesterday that Cipollone is Italian for big onion. So from now on, he's going to be known as ECB's onion from this day forth. ECB's Nagel said we could see price pressure in the Eurozone continue for some time. It's not completely clear if inflation will reach the 2% target next year and stay at this level. But says the likelihood of a rate cut in June has increased. And so he's not, Nagel, being of German nature, is not ready to declare victory on inflation or the path of inflation just yet. ECB Schnabel had a piece out on inflation forecasting. I haven't read the full piece yet, but I've had a quick scan. And the one line that she came out with was that forecast errors contributed to the central bank's delayed reaction to the surge in inflation that we started a couple of years ago. If you can't get that right, and that's your whole job, then we're in a bit of trouble. Anyway, ECB's Vasile says he sees the deposit rate much closer to 3% by the year end if disinflation goes to plan. ECB's Lagarde popped up saying we're clearly seeing timid signs of recovery in the euro area. Then also put the cat amongst the pigeons by saying we are monitoring the FX rate very carefully, which they don't target the exchange rate, as she actually said in her last speech. They do monitor it, but that comment was maybe a bit stronger given what's going on in FX at the moment. Why does she feel the need to drop that one, NK?
Well, they do bring it up regularly during the meetings as well. So perhaps she says like, okay, be careful because when the FX is affected. But she said something as well, like about a year and a half ago, or I don't recall whether it was her or the chief economist Lane saying that it has to move like 5 or 10% to really have a material impact on CPI. For the rest, I don't know why she really mentioned the FX. Is it like to try and put a little bit of a break on the dollar's wrecking ball moves that we've seen over the past month and a half? It's possible, but she's also worried about those higher energy prices and things. So yeah, it's all about the fight against deflation, I trust, and not knowing how to handle it.
Yeah.
There's no way that ECB is ready to intervene to support the euro. There's absolutely
Oh, no, not at all.
zero risk, unless we go perhaps down below parity. But I mean, right here and now, there's absolutely nothing. They also know, and central bankers left, right, and center also comment about that the difference between growth in the US and elsewhere is big enough to support what's happening in the dollar right now. So I don't think there's anything more than that to take from it.
Yeah, thanks, mate. Right, over to a little bit of US data. There wasn't much out at all yesterday. I'm still keeping a half eye on the NBA mortgage numbers. There's not a lot going on there in terms of overall activity, but this rate is starting to tick up again, the mortgage rate. It's not affecting refinancing index at the moment, which is something you might expect it to. Obviously, if the higher the rate goes, then you get people finding it a little too expensive to remortgage, so they stay on their current rate and people don't move. It can cause a bit of a slowdown in the housing market. We're not quite up at the peak we saw late last year, closer to 8%, but we are creeping higher in that mortgage rate. So that may be something that starts to put some brakes on the housing market. We saw maybe something happening with starts and permits this week, both of those dropping, but we've seen that happen before and it's turned out to be nothing. But we saw that over this period as well. So let's just see if that continues. But that rate is creeping up once more and going above 7%. We also got the Fed's Beige Book, which is their sort of regional bank survey thingy, and that pointed out that employment had risen at a slight pace overall, but overall economic activity expanded slightly since late February. But anyway, long story short, there was no big warnings in there that anything is breaking, shall we say. Fed's Mester was out saying we want to get more information before we can say inflation is on a sustainable path to 2%. Fed's Bowman says progress on inflation has slowed and perhaps stalled. Says current monetary policy is restrictive, but time will tell if it is sufficiently restrictive. That's some hawkish comments from Bowman there. On the job cut front, Google is apparently laying off more employees and moving roles to other countries, although no numbers have been put on that story that I can see at the moment. So just a headline. In the auto sector, things aren't looking great there either. Again, Ford is having to recall over 450,000 US vehicles, apparently because of a loss of drive power from a low battery or something. So that's going to cost them a pretty penny. On the central bank forecast front, Deutsche Bank has moved its date for a first BOE rate cut to June from May. Bank of America expects a June rate cut from the Bank of Canada and they expect a rate of 3.75 by the end of 2024. That's 125 pips of cuts, or 5 25 pip cuts this year. They've only got 5 meetings left, including the June one. So that would just be Bank of America seeing a cut coming at every Bank of Canada meeting. UBS says the Fed is on track to cut rates by twice this year, and they are going to start in September. Geopolitics, we've got this constant back and forth between Israel and Iran going on. It's all a bit of showboating at the moment. The markets seem to become a bit numb to it, but a US official, and further confirmation of this came this morning, US official overnight, and then say another headline this morning said Israel will likely not do anything until after Passover. So I think that's the 22nd, if I'm not mistaken. So after the 22nd, as we know from what Iran did, we expected them not to do anything until the end of Ramadan. That passed. It was all well telegraphed, and then they went ahead. So we should probably expect a similar thing, that this will be well telegraphed, any reaction from Israel, and we just have to wait and see whether it's again a bit of something for show rather than anything that's too damaging, just to show at home that they're standing up to this. If it is something far bigger, then that's obviously going to affect risk markets. If it's not, we'll probably see a similar reaction that we did after the Iran launch. Let's call it that. Okay, anything on that you want to comment about, or anything else you got to bring to our attention?
Not really. This Passover thing, is that just one day, or does it last a whole week? Because I saw somewhere it lasts from the 22nd till the 30th also. I don't know. I mean,
recall. I think the main day is the 22nd. I don't know if it starts before or from this weekend, or I don't know. I'll have to look it up.
No, not a lot else, mate. No.
Cool.
Nothing more to report overnight. I think you covered everything. Mostly the doves were out from the ECB. Bailey a bit dovish. I wonder if I'm starting to get cursed by Bailey, because I bought some euro sterling this morning, and it's not going anywhere.
Yeah, I did actually look. I saw that rally. I didn't actually notice it yesterday, and I only noticed it this morning. And banging up against that bloody 70 level again.
Exactly. You see, Gavin also says it's from the 22nd to the 30th. So it could be that we are in for nearly 2 weeks of a bit of a stand down. But then I've already heard that they are amassing troops near Rafah. I think the misery is far from over there, right? Yeah, exactly. Yeah, Michael, that's what I saw as well. It's 8 days. Yeah. So so I think until the 30th.
Yeah, very much so. So thanks for that, guys, for clarifying that. So it looks like we might have a bit of a break of that, thankfully. No more hostilities going on. We don't like to hear about such stuff. Right, so let's have a look around at what's going on. It seems to be a bit of a pause day again today, for lack of any headlines and whatnot. We'll start with euro sterling. Managed to get down 85.20, which is another one. It's just an area where we can hang around. You need something stronger to get down to 85. When it's less strong, we seem to hit this 15-20 area before bouncing. But then again, look, we keep running into this level up here. And it just, I had a conversation with one of our roomies just talking about S&P yesterday, why a particular level, why the 50-80 had become important. We saw it being the resistance area yesterday before we got the breakdown. And there's no real particular reason why sometimes you get levels like that. I'll show you this quickly. So there's the 50-80. We couldn't get through it, and then we can't get through one way, we have a breakdown the other way. But for euro sterling, it's a similar thing. Sometimes there's no rhyme or reason why these levels show up, and why they constantly have a say in things. You know, that's the way it is, and all you can do is stick a line there and watch it, and you can use it to judge your trades around. But there's lots of levels, as you know, all over many different pairs. There's levels. I could probably reel off 5-10 levels in various pairs that always have a say, like 108, 30, 70 in euro dollar, 147 dollar yen. You know, there's just levels that show up time and time again, and you know, if you know they're there, you know what to do with them. You either trade them, you don't, or you use them as a bit of a pivot line. So that's what's going on here. 85.20, 85.70, 50
The issue
pips.
is we're looking at a 3% vol currency.
Yeah, that's one reason. Yeah,
Far too cheap to buy options. Far too cheap. So I mean, it's gonna take something really moving to really get a break in this euro sterling. Yeah.
Yeah, you know, watching it for months. Do you have any thoughts on why levels show up and you know, repeat? You know, even when there's no real technical basis for them to do so.
No, not really. Not really. We used to have those levels in the old days, the 2080s, 3070s, showing up, but then no, I don't really think so, you know.
Yeah.
It's more yeah, perhaps a bit of just a psychological thing. If it goes like 20, 25, 30 pips above or below a big figure, people tend to cover some stuff, and no, I don't see too much of a psychological or so. No, I don't.
No worries, mate. See, it's one of those mysteries of the trading world that we have to deal with, but it's all about patterns as well. So we've had a continued bit of you know, dollar sell-off or dollar easing from what we've seen. It still doesn't look anything really significant. It just looks like it's a bit of a corrective move. You know, euro dollar had a little creep up towards 107, but it's already ran out of puff at around 90. So now we'll see what it wants to do here. We're just going to mooch around 106, 107 for a while. It's going to take something, I think, as I said yesterday, going to take something extra now to bring another leg higher in the dollar generally, because we've come through meetings, data, POW, and this is where we're at. So we're looking like we might be priced for whatever it wants to be priced for. Vols are still doing okay, still in the 6%, but they're dipping a bit at the moment in euro dollar. Dollar yen was up in the 9s, 9.4 some at one point today. Now it's down at 8.4. So we're seeing volatility just dipping a little bit at the moment. We know what the level is, 107 now, 106. That's your ballpark. Look for a break either side to get the next real direction. Or if you fancy scalping between the goalposts, there's a big enough range for you to do so. I would be expecting, with no big news, maybe another dip to pull up maybe around the 15-20 area. That would lend further cement to these lows down here at the big figure. So if you do see a pullback, that's where I'd expect maybe we see some trouble with these buyers protecting those buys around the 20 area for that one. Cable, that's still stuck 124, 125. Hasn't really managed to have another little creep up to 125. Again, just tells you the lack of conviction going on at the moment when we're still pivoting around this 124.50. There's that lack of conviction that I've got a lot of at the moment. I've caught the same bug. I haven't got a view on anything really at the moment. I know others feel similar. One thing I wanted to touch on, our mate Gavin was talking in the chat room about you know, missing trades, and you know, you get the idea right and you miss it. I've had plenty of that these last couple of weeks. But there's nothing wrong with missing a trade. Don't kick yourself too much over missing a trade. I probably talk myself out or miss more trades than I actually put on, just because that's the way I am. I'm just a cautious trader. But there's nothing wrong with missing something. The problem arises if you miss something and then try and chase another trade after. That's where you tend to get into trouble. You've had a good idea, it would have worked out, you've missed it, you think, right, I've got to make up for that now, and then maybe you don't put in the same sort of thought process and caution and management that you would in the secondary trade, and then you get caught out and think, well, why did I do that? So then never kick yourself for missing a trade. As Gavin says, log it down, note it, note how you missed it, what you did wrong, journal it. That can help you for the future. And then just carry on. You can be, take some positivity that you called it right, even if you didn't trade it. And me and Kay have talked about that this week as well. So yeah, don't bash yourself on the head just because you missed something. What else is going on? Dollar China, that got a little tap on the head. I still think this one is a bit at the mercy of what's going on in the dollar more than China. They did one thing they did say, the PBOC, in their usual weekly comments, that they were going to keep the currency stable. So they're not ready to let this wander anywhere in particular at the moment. So we're still in this pretty tight range, although it is still being a bit more elevated than it has been. We're still keeping this sort of rough, just gradual uptrend. So we're not out the woods in terms of these highs, but they're not willing to let it go. Again, we're dipping a bit this morning as we're seeing that dollar dipping a bit also. Dollar Max, still keep an eye on this one. I still fancy short. This is one I do fancy shorting, but again, I've just not got a conviction to pull the trigger. Maybe if we get a move back into this zone and we hold below the top of that zone, 1705, and at least below these highs. If I see a move like that, then maybe I'll think, okay, we might be putting in a bit more of a top here. So I'll give it a little go. This one might be at the mercy of oil as well, which is softening off, possibly on those Israel or those delay headlines, giving the oil market a bit of a breather. MEX obviously being a big commodity currency for oil, might be feeling a bit of that as well. Kay, I know you're sharing my same lack of conviction in a lot of stuff. I've actually only got 3 trades on at the moment. And one of those is my euro, sterling, and dollar China, which I've been in for months anyway. You got any inspiration for us?
Watching a couple of things. I went out and then back in. Let me just pick the screen here. There you go. Whoops. Yeah, I've been in and out of this one. At one point, I even cut my position completely in this euro dollar. But I'm decided that I still, just based on fundamentals, want to have something in it. I think if we get back below 106.60, 65-ish, the bears will be a bit more confident again. But on the top side, we just tagged the 23.6 this morning of this move. So that still tells me that it's all corrective right now. For as long as we are capped, as you say, below 107, and I would even stretch it to this 107.10 and then 107. What is that? 107.25.30 or so. It's still. I think we're still in a correction mode here. We've got this one big move lower, then the correction here, then we got the another one big lower. It can correct up to 107.30 without changing the whole picture. So I'm very reluctant to call this a reversal yet, especially if you look at the fundamentals, right? If you look at those US data, which are still like on the average better than virtually anywhere else, right? What we can't forget though is that psychologically this market is always ready to sell dollars for some reason, and we do have the Philly Fed this afternoon. I don't think the claims will do anything, but we have the Philly Fed manufacturing index out this morning and business conditions, and again I think. Look at the employment index over there. Although we know manufacturing, and it's only a regional one, but keep an eye on those employment and prices data, because the market is, as I said, just loving to sell dollars at times. But until we really start to break back above those levels here, I think this is still corrective, and as you say, cable, about the same thing. We did our move lower. We did the move lower here in two moves, and now we are yeah, just ranging a bit for as long as we are below 125 and then 125.20 here, and then above 125.5, then we may start to look at something different and more constructive in sterling, I'd say. Aussie, well, and again, it's intraday, and yesterday I was already saying, like, for as long as it's capped around 64.5, nothing changes. I would even add the 64.80, 80.85, psychologically 65, the figure perhaps. But we had a bit of a spike above on in sympathy with the rest of the dollars, but it is already putting up a little bit of a fight this level. So I'd say for the intraday traders, watch what it does here around this 50. If we move back above, start to hold, then I think there's another perhaps 30, 50 points to go. 64.80 for a starter. I think here these levels have shown up quite regularly. This is going to be one that the market is watching. And then we have a bit of a fib here going as well, just above. And on the downside, not a lot, right? If this starts to cap again and the dollar is regaining strength, we have to look at our 63.90 figure again for further developments. As we are saying, our conviction right now is not really very strong. I'm really running very reduced positions. I'm just watching what happens. We always know tomorrow, Friday, bit nervosity perhaps ahead of the weekend, although it should be less than before than last Friday, for instance. Kiwi tried below 59. Could be a fake if you look at this channel. Could be a fake. Let's see if it gets back up to 59.5 and see what it does over there. But all the currencies and all those dollar pairs looking very, very similar, right? They're all in corrective mode. But again, if the dollar starts to regain strength, 59, 58.95, yeah, 58.95, 59 the figure. That's going to be an interesting enough level. If we start to break back below, then perhaps, or likely, I would even say, this dollar move is going to pick up again. Swissy, the 96.75 Euro Swiss held again, as I already showed, but the bounces are a little limited. So I bought a few yesterday, but let some go around fixing time as well, and just managing what I've got right now, and monitoring this 96.75 for a hold again. But a break below, I won't really hold on too much to it. Dollar Schweiz, it's a bit struggling like the rest of the dollars, right? Bit struggling like the rest of the dollars, but 90.5, this zone here, 90.5, 90, 70. That's it's a bit of a broken trend line here, as you can see. That's going to be a first real level, I'd say. It's looking a bit sluggish, and it's looking Swiss pairs in general looking slightly sluggish, but it's perhaps just lack of drivers, and people just managing their positions right now. But anyway, I'm actually flat in dollar Swiss right now. Going to respect this level up here. If we start to break back above, I'm probably going to re-enter or monitor what's happening if we come closer to 90.5 and low 90s, high 89s. I think in this zone here, it should really hold for the more medium term that I'm talking. That's I haven't got really too much more to say. Euromex came back to the prior low here. It's still capped up there. I'm same as you in the dollar mix, but I'm still rather watching the euro mix. Tempting to start to build again, because if risk wanes a bit, this could reverse, but then it's trading very much with what's happening in the S&P or in the US equity markets right now. So I'm just trying to be a bit patient on this one. Yeah, let's just have a quick look at the dollar yen. So still 155 here, okay. 153.60 on the downside, and I'm just showing it because those risks, you know, the market is not ignoring the risks, but we are still very bit on the dollar yen. Yesterday there was a little bit, or the day before there was a bit of a scare. Overnight we also visited just below 154 the figure, but I think 153.60, if it would go naturally below there, then we can have a bit of acceleration for another big figure and a half. But and that could happen, you know, when Ueda and Suzuki will return to Japan. So I am looking for the next week and a half, and I'm just trying to wait for long enough to make it cheap enough to perhaps just buy a put in this 152 area or so when it's cheap enough to just play the risk of an intervention. And but I won't risk any cash, because if they don't intervene, if nothing happening, this thing is likely going to trade to 155, 156, and why not talk about 160? So again, I'm not convinced enough to have any cash positions running right here. And I think that's enough for today. Ryan, back over to you, mate.
Yeah, thank you very much, mate. I did want to grab it back just quickly because I did want to have a look at that breakdown in the S&P. Let me just get the screen back. Boom and boom. Hopefully you're seeing that okay. Yeah, now I'm out all my longs, even my 48 10s that started off this whole thing. This breakdown of this zone is looking a bit significant at the moment. We got down into it. It was trying. I know a lot of other people were buying into this zone as well. I had a final dibble yesterday at 41s. I managed to knock some out 55s odds before 56s before it turned around. Now we're holding below this zone. Now this is still a short-term zone. This was all built on the way up, but again, it just shows you when the market starts changing. We wanted it, or it needed to start breaking support points. It broke this one up here, go through a lot of the minor levels, held this one, then we ping-ponged up to 50.80, then we've broken it. Now we're holding below. So this now suggests that we've got something different on our hands now. Still have to look at the wider context. I know a lot of people are taking fibs off this second part of the phase, the rally, but I prefer to stick to the main one. So the 38.2 of this big trend is still way below. So yeah, there's lots of room for it to get down here, but that could be where, if this trend isn't going to break, that's where we start getting the buyers stepping in. And there's another zone, couple of zones just below or just above that, around 49s, 48 and a halves, where the market may do something just as we creep down there. So yeah, a lot of people saying it, this is it. All the bears are jumping for joy, saying this is the end of it. Not necessarily. Depends on what timeline you're looking at. Short term, yeah, very much so bearish. That's clear as a nose on your face. But longer term remains to be seen. So I'll let the levels do the talking. On that front, yeah, we shall call it a day. Have a great day for the rest of the day. Thank you very much, as always, K-Man. And I will see you bright and breezy in the morning tomorrow. Have a good one, folks.
Cheers, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.